Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of business, and boy do we have a report for you today. This is Enphase Energy's 2025 filing, and it is a doozy packed with numbers, risks, and a look at how they plan to power our future. Before we dive into the nitty-gritty of their latest numbers, if you love getting these kinds of breakdowns without the corporate jargon, make sure you hit that subscribe button. And hey, we've got a growing community over on Discord, linked right below, where you can chat with us and other finance enthusiasts. First off, Enphase Energy Incorporated, a company making waves in the energy tech world, has released its official annual report. They're the folks behind those smart microinverters that work with almost any solar panel, aiming to make clean energy simple and effective for homeowners. They've shipped a lot of these little powerhouses. Over 86 million by the end of 2025, and their systems are in millions of homes around the globe. Now, let's get to the heart of the matter, the financials. For 2025, Enphase brought in $1.47 billion in revenue. That is an 11% jump from 2024. This increase was mainly fueled by a pretty significant 36% boost in their IQ battery sales, measured in megawatt hours. On the flip side, they sold about 2% fewer microinverter units, which shows a shift in their business focus. The United States is clearly their strong suit, accounting for a massive $1.19 billion, or 27% more than the previous year. A good chunk of this US growth, about $91 million, came from special safe harbor transactions related to tax benefits. Internationally, however, things were a bit tougher. Revenue dropped by 28%, or $111 million. Mainly due to a slowdown in Europe impacted by a weaker economy and changes in government policies and lower electricity rates. Their cost of revenue went up by 12% to $786 million, a bit more than their revenue growth. This meant their gross profit, which is what is left after paying for the direct costs of making their products, only grew by 9% to $687 million. Their gross margin, the percentage they make on each dollar of revenue, edged down from 47.3% to 46%. This dip is blamed on a less favorable mix of products sold and higher tariff costs, but here is a crucial point: they got a big boost from US tax credits, specifically the Advanced Manufacturing Production Tax Credit, or in PTC. This credit reduced their costs by a whopping $239 million in 2025, which is a lot more than the $158 million they got in 2024. Without these credits, their gross margin would have looked quite different. On the innovation front, their spending on research and development actually decreased by 6% to $189 million. This was mainly due to some restructuring efforts at the end of 2024 that led to fewer employees in R&D, saving them about $7.7 million. They also cut back on equipment and professional services. Similarly, sales and marketing expenses dropped by 4% to $197 million. This was also a result of those restructuring actions, moving some functions to more cost-effective regions and using more artificial intelligence. General and administrative expenses, which cover things like executive salaries and legal fees, ticked up by 4% to $136 million. This increase was mostly due to higher personnel costs, including bonuses and stock-based compensation, and more spending on legal and professional services. The cost of those restructuring efforts continued, with $7.1 million in charges for 2025. This included employee severance and some asset write-downs. Remember, in 2024, these costs were higher at $13.2 million. Looking at other income, their interest income took a hit, dropping 19% to $62.7 million. This makes sense as they had less cash sitting around in investments, and interest rates likely decreased from their high in the previous year. Their other income expense net line saw a big swing. In 2025, it was an expense of almost $11 million, largely due to a non-cash charge related to the changing market value of some debt investments. In 2024, they had a much larger expense of $25.5 million, mainly from writing down the value of some of their investments in private companies. And then there are taxes. Their income tax provision more than doubled from $17.5 million in 2024 to $32.7 million in 2025. This increase reflects their higher profits in both the US and internationally, plus some extra tax costs related to employee stock awards and adjustments from previous years. Now let's talk about the company's cash situation. As of the end of 2025, Enphase had about $1.5 billion in cash equivalents, and marketable securities. That is a decrease of about $205 million from the year before. This drop is mainly because they bought back some of their own stock, paid off some debt, and invested in other companies. Their total debt also went down by about $98 million, mainly because they paid off some older convertible notes. Still, they have over $1.2 billion in convertible notes outstanding, which could become a bigger headache if those notes start converting into shares. Cash flow from operations, which is the cash generated from their main business, took a dive, down by $377 million compared to 2024. This was primarily due to using more cash for things like prepaid income taxes and building up their inventory. While their net income increased, these operational cash uses were a big drain. Their investing activities provided about $107 million in cash, mainly from selling off some of their investments. However, they also spent a significant amount, over $48 million, on issuing loans to private companies and over $40 million on new manufacturing equipment and its upgrades. Financing activities, on the other hand, used up about $242 million in cash in 2025. This was largely for buying back their own stock, paying off those maturing convertible notes, and covering employee stock tax withholdings. Let's quickly peek at their inventory. It tripled from $165 million to $288 million. A big reason for this is that they started their own manufacturing in Texas in late 2025, which naturally increases raw materials and work-in-process inventory. Their accounts receivable, essentially money owed to them by customers, also saw an increase. But what is interesting here is the change in their allowance for credit losses. It dropped dramatically from $7.8 million in 2024 to just $0.6 million in 2025. This is largely because a big chunk of that 2024 allowance was for a customer that went bankrupt. They wrote off $6.2 million of that debt in 2025, but it shows they're not expecting as many bad debts this year. Now, warranty obligations are a big deal for a company that makes products with long lifespans like Enphase. Their total warranty obligations grew to $214 million, with a significant portion of that being long-term. For 2025, they added $12.5 million due to increased product replacement costs from tariffs and some ongoing analysis of past product issues. But it was partly offset by lower replacement costs for their IQ batteries, thanks to their growing service network. Looking at intangible assets, amortization expenses related to things like developed technology and customer relationships have gone down, reflecting that these assets are being used up over time. Now, about those convertible notes, they have two big ones outstanding. One due in 2028 for $575 million and another maturing in March 2026 for $632.5 million. These notes don't pay regular interest, which sounds great, but they can be converted into shares of Enphase stock. The 2026 notes are almost due, and the company has decided to settle them with a mix of cash and stock. This could mean more shares hitting the market, potentially diluting existing shareholders. They also have these complex hedging and warrant transactions tied to these notes, which basically aim to limit dilution but add a layer of financial complexity. Let's revisit taxes with a newer disclosure rule. For 2025, their effective tax rate was 15.9%, significantly lower than the 21% federal rate. This is largely thanks to a massive $50 million non-taxable benefit from those advanced manufacturing production tax credits, or MPTCs. It is clear these credits are playing a huge role in their bottom line. After all the costs, revenues, taxes, and other financial gymnastics, Enphase Energy reported a net income of $172 million for 2025. That is a healthy increase from $103 million in 2024, but a significant drop from the $439 million they made in 2023. But it is not all smooth sailing for Enphase. Their risk factors section is quite a read. They're really worried about government subsidies and incentives for solar power disappearing or changing, which could hurt demand. The new One Big Beautiful Bill Act, or OBBA, is a big concern, potentially impacting tax credits, especially with new rules about domestic content and foreign entities of concern, or FEOCs. If they can't meet these tougher rules, their products might not qualify for those valuable tax credits, hurting their competitiveness. This domestic content and FEO stuff is serious. It means that starting in 2026, more and more parts in their products need to be made in the US or friendly countries, and not from places that could be considered foreign entities of concern. This could force them to change their supply chain significantly and might even make their products too expensive or ineligible for credits. Remember those LFP battery cells they get exclusively from China. That is a clear vulnerability here. They're also bracing for tough economic times with inflation, tariffs, and interest rates all playing a role. They admit these conditions could make customers hesitant to buy their products. Competition is another huge worry, with big players like SolarEdge and Huawei constantly innovating. They're also aware that their competitors have more money and resources, and could undercut them on price, Plus, new technologies could always disrupt their market. And then there are the tech risks like cybersecurity threats and the constant need to protect their intellectual property. They're dependent on complex IT systems, and any breach could be costly. It is a reminder that even with clean energy goals, the digital world is a minefield. The evolving data privacy laws are also a headache, with strict rules in places like Europe and Brazil that could require costly changes to how they handle customer information. On a more positive note, management reported effective internal controls over financial reporting, and their independent auditor, Deloitte CBAMP, Touch LLP agreed, giving them an unqualified opinion on their financial statements. That is always good to see. Now, looking at their stock itself, it trades on the Nasdaq under the symbol ENPH, they don't pay dividends, and any return for investors comes from the stock price going up. They do have a share repurchase program, and as of the end of 2025, they had about $269 million left to buy back shares. The stock performance graph from 2020 to 2025 tells a tough story. While the S&P Small Cap 600 Index and the Invesco Solar ETF saw gains, Enphase's stock value has dropped significantly. An initial $100 investment at the end of 2020 was only worth about $18 by the end of 2025, which is a really rough ride for shareholders. So, what is the takeaway here? Enphase is navigating a complex and changing landscape. They're making progress in selling more batteries and benefiting hugely from US tax credits, especially with their move towards domestic manufacturing. However, they're facing a significant international slowdown, intense competition, and the ever-present risk of regulatory changes impacting their core business. The drop in stock performance is a stark warning sign, suggesting investors are concerned about these headwinds. While the AMPTC credits are a major financial lifeline right now, the company needs to show it can grow and remain profitable without them, while also managing the risks tied to international markets and domestic content rules. Their future direction hinges on successfully balancing these factors and continuing to innovate in a highly competitive and regulated industry. What do you think about Enphase's performance and their outlook? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives like this, and definitely check out our Discord community in the description for more discussions. Thanks for watching, and we'll see you in the next one.